Thank you very much for having me here this afternoon. I'm going to talk about the energy landscape in terms of fossil fuel prices. Coming from Norway, with lots of oil, it's sort of a natural theme, which I'm quite interested in and I talk about and look at all the time. Very broadly, I mean, through my since 2008, I've been working in SEB commodity analysis in general, both for metals and agricultural products, all the energies, precious metals as well. Primarily, I'm looking at oil and energy because that's where the most of our business is. But if you look at all the different commodities since 2000, you see a very, very similar pattern. Sort of all up and then all down, and again, as well, amplified by a lot of weakening US dollar and then a strengthening in the US dollar again. Since all commodities are denominated in US dollars, it has a big impact on the level of the price as well. But, I mean, we've had this incredible boom, and then we have this incredible bust in commodity prices across the board, not just energy. And if you look on the pattern here, is that since 2010, 2011, all commodity prices have gone down. And then you have this strange thing about oil going sideways and not following the others. And that was primarily the crisis in the Middle East, which made it different from the other commodities. And we continued to live for 4 years in a world where we saw all the other commodities collapsing around us. We thought oil was special. And then it turned out it wasn't anyhow. Well, so this is the big picture. We had a seminar in London earlier this autumn talking about industrial metals, and we had all these projections about supply, demand, surplus, deficits and everything, calculated, forecasted prices and everything, and there was one guy who'd been working in the mining and metals business for 40 years. I said, you know, we don't know shit, but one thing we do know is that this business is cyclical, and it will turn sooner or later, or sometime. We don't know when, but it will. And I think this is partly a consequence of too low investments during the 90s. And then when you had accelerating consumption growth from China and emerging markets, you had underinvestment. So it's not so that you had these exceptionally high consumption growth rates for commodities. But they were solid and strong, but not out of the ordinary. It was underinvestments from previous periods. And that is a typical recipe of boom and bust and cyclical commodities. And commodities are cyclical. You know? And what do? The price goes up, and you invest too much. And then it becomes too much, and price collapse. And then you cut all investments. And what do? You invest too little. So it's basically the recipe for the next boom. We don't know when. If you look on oil, we have the biggest cuts in investments in history. We're going to have cuts in investments 3 years in a row. It's never happened before. So it's the classic recipe. But of course, the picture is much more diversified than that. But this is, so energy is doing exactly like all the other commodities are doing. But one important thing here is that when prices goes up, everyone are screaming for growth. More volume. You need to have visions of how you're going to increase your production. Don't focus on cost, focus on more production. And that's what companies do. They listen to investors, they do what the investors say. And what happens? Cost goes up just as much as the price of the commodity. And this is our picture of commodities of the last 10, 15 years. It's been more and more and more expensive to produce them. And that's because no one cares about cost. So in the end, looking back 1 year, Statoil in Norway made less money in 2014 than they did in 2000. You know, because costs have gone up even more than prices. And then what do you think happens when prices go down? Costs go down as well, because now everyone is screaming, don't care about volumes, care about cost. So everyone focus on cost, and then costs are pricing, costs are falling. So typically this is the cost index for upstream oil and gas over since the year 2000. Well, about 230%. it should have gone up by no more than 30%. And now it's going down. So, we can live with low oil prices. If you look at the oil project called Johan Castberg in the North Sea, 1 year ago, it was assumed to cost $95 to extract. What do you think the price is today? Just 1 year after. It's $60. It's like magic. So cost is not something that is very explicit. It's very adaptable to the world that we are living in. So Norway is probably going to live pretty nicely. We don't know if the oil price goes back to $60. And then looking at coal, oil, gas, back from 1990. We see that the price of coal and gas is almost the same as it was in 1990. Oil, not quite yet. But when I talk to some hedge fund in London, they say, it's not about the oil price either being $70 or $100. It's about the oil price being either $70 or $35. That's your space. And so if you look on the long term, average price, real prices for oil, it's maybe more like $35. And maybe it's not impossible, given that costs are progressing as well as lower prices. Looking at coal specifically, we've seen this incredible fall in the coal price. It got more than $200 in 2008. Of course, the weak US dollar, so nominally impacted by the US dollar, but still, we had this peak, and I think everyone expected coal prices to go like this or something like that. And it's just been falling and falling and falling. The interesting thing here is that if you look on the producers of coal, South Africa, Russia, Canada, Brazil, Australia, look at their currencies since 2013, depreciated by some 40 to 60%. They have their costs in local currency, but income in US dollar. So if they can lower the currency, they can continue to produce because they get income in dollars, which is then converted to local currencies and creates a lot. So looking at Russia today, for example, they are not so hurt by the low oil price because the ruble has collapsed. So income in ruble terms from sales and exports of oil are still pretty good. And their costs are in rubles, so they can cover the cost and pay the workers and pay the extraction. So this is, in coal, all the commodity producing countries, they have been protected by a much weaker currency. Also in Norway, the Norwegian kroner used to be 10 to 20% stronger than the Swedish. Now it's in parity. And it's lost some 40% versus the US dollar. So currencies is a big part of the adapting costs in a lower price environment. So if you then look at the typical cost curve just 1 year back, so before the US dollar rally last year started mid last year, you can see that average cash cost of producing coal, seaborne coal, was basically $50. And what is the price of coal today? $45. So it's even less. We know that a lot of these producers are losing money. But still, if you then say that most of these coal-producing countries have lowered their currencies by 40 to 60%, you should basically lower this US dollar-denominated cost curve by the same, more or less. Which means that maybe this point, $70, which is sort of a fair long-term price for coal, it's lower down towards the 59 level. So currencies are hugely impacting the sort of the cost picture. We thought we knew what it would cost to produce coal in dollar terms, but it's produced in local currencies in other countries than in the US, so it's a different picture. If you look at the LNG, I think just general picture of the coal market before going to LNG is that everyone expected China to have growing consumption and growing imports of coal for decades to come. And they would open a coal-fired power plant every week. And now it looks like they're instead closing down a coal-fired power plant every week. Also, they have huge amount of coal reserves themselves, so instead of importing more coal, they're importing less coal, because they're using more of their own coal as well. So imports of coal to China is falling, at the same time as investments in new coal capacity and coal supply is rolling into the market, because it takes maybe 10 years to plan for increasing production of commodities. That's why it's cyclical. You start to plan for more production in 2005, it comes into the market in 2015 when no one needs it. You know, so it's impossible to plan. That's your cyclicality. And then we cut investments now because we think no one will need it, and then they will need it in 5 years and there's nothing there. Again, the cyclicality. So, too much coal for the next 5 years at least. That's pretty certain. And it doesn't have a good reputation politically either. It's quite polluting, and you can't breathe in Shanghai and Beijing and anywhere. So it's, you know, we don't like coal. Indians like coal, but still it has a bad reputation, and it's too much of it. On the natural gas side, it's completely the same picture of long lead times, big infrastructure projects to get LNG into the market. Looking ahead, and this is the funny thing, looking into the future is so difficult. You always think that the future is going to look like today. If it's strong demand today, you think it's going to be strong demand for the next 10 years. If price is high today, when the oil price was 100, everyone's saying, you know, when I sit down and think really hard about it, take all the parameters into account, I think that the future price of oil is going to be $100. You know, that's the future thinking. And it's so hard to think different from what you see around you today. And exactly the same thing with natural gas as in all the other commodities. High consumption growth, big investments, investors screaming for growth, and that's what you do. And our consumption suddenly looks quite different. We're going to have a big ramp up of exports coming out of Australia towards 2020. We have a big increase in exports of LNG coming out of the US towards 2020. And suddenly demand doesn't look so strong, and prices are collapsing. A lot of this gas here was probably destined for Asia, but it will also head to Europe. And we have had a big drop in the gas price in Europe, and it's going to be dropping further. And Russia has to decide, do they want to compete for price or volume in Europe? And I think they will go for volume, and we're going to have an intense price fight of natural gas in Europe with low prices. So we're not there yet. We have fallen quite far already, but we're not there yet. And then, of course, technology. You know, it's really shifting the space so much. Everyone have heard about shale oil production in the US, unlocking a huge amount of new supply of oil in the world. Suddenly, there is no thought even that we are missing or going to be missing volumes of oil. It's going to be more than enough. So this is the typical how it works. You start to produce, this is months after initiating production, and you have very high production to start with, and it falls really rapidly. And maybe you have 2/3 of all production happens the first 3 years. And in order to be able to increase production, you have to drill a lot all the time. And then you can accumulate more production. And then the moment you stop producing, production will fall like this. So this is good and bad. It looks really bad, but in many ways it's really good. Because it means that whatever you produce is produced within 2 years, 3 years, mostly. So when you do these investments, you get your money back and the return within 2 years. If you compare that to the North Sea and offshore oil market, you start to plan today, you look for oil, you start to invest, and you start to produce in 5 to 6 years' time, then you produce for 5 years before you start to make a profit. So 10 years horizon in an uncertain world versus certainty in 2 years. You can actually sell forward prices in the financial market, lock in your profit, and you're slam dunk guaranteed a profit on your activity. And how long that time does it take from planning stage to drilling and to production? Maximum 3 months versus 5 years. So this is the new thing. We've got a new source of oil into the market, and it's huge volume, and it's extremely adaptable and fast response time. It can ramp up very quickly if it's needed. And then what do the companies say? You know, they said, well, you know, the cost of drilling is falling really rapidly. You know, from $8.8 million for a new well, total cost included, and now it costs like 7, 6.5 eventually. And then, how fast can you drill? Well, it used to be like 20 days. Now we can do it as little as 5.6 days at best. And but you know, this means a lot for profitability. So here's okay. An area called Eagle Ford, in 2012, at $95, they had 60% profit. They have the same profit today at $60, and even at $50, it's still a good profit. And another field called Delaware Basin Leonard, they actually have better profit today at $50 than at $95 in 2012. This is due to improvement of technology and improvement of processes. And typically, if you look at drilling, back in 2010, it took 2 months to make one new oil well. And now you can make 2 oil wells in 1 month. So if you look at the number of rigs here, in blue, you see they were close to 200 rigs, and then it dropped down to now like 70 rigs. And you're still producing as much, because you're drilling much faster. So I mean, we've had this incredible drop in rigs, but it doesn't matter, because the rigs they use are twice as good or 4 times as good. And that's just one part of it, because in addition to drilling faster, each well is producing more. So the wells they were drilling in 2014 are producing maybe half as much as they are today. In perspective, every year the world consumes some 35 billion barrels of oil. That's a total consumption of oil in the world for 1 year. If you look at the oil reserves from US shale, looking at oil in place, it's about 2,000 billion barrels. Unknown still, but that's sort of maybe something like that. And recoverable is maybe between 10 to 20%. If you look on drilling efficiency, how much you get out of the well because of new technology, the way you drill it, the way you frack it, and extract the oil from the well, that is improving maybe 2% every month, every year, but every month. You know, it's an incredible speed of improvements in the way they actually manage to get oil out of the wells. And if you look at the size of the total oil in place, 2,000 billion barrels, and assume that you can improve extraction rates of how much you actually can extract from these resources by 1% per year, you actually increase your recoverable reserves from US shale oil by 20 billion barrels every year. That's close to what you actually consume in the world every year, just by tweaking your technology by 1% every year. So it's an incredible amount of source of oil. And if you look at the cost picture, ultra deep water or deep water, very expensive in general, very easy to be onshore in the US, very clear rules and regulations, no deep water, quite easy. And what do we see that the oil companies are doing? They're going onshore in the US. So they're cutting investments and assets in this space quite big time. But as I said, costs are going to fall to be competitive. But for now, this is really what is ruling the market. So that was the production side. Completely new dynamics, and lots of it. And then what about the consumption side? You know, if you look historically on it, consumption of oil has for decades been concentrated in the transportation sector. And that's why it has been able to have a unique high price. It has been protected from competition. It's been difficult to use something else than oil. But that is cracking now. It's breaking up. Technology is breaking up this unique position in the transportation sector. Increasingly, you see LNG and natural gas being used gradually in trucking and also private cars with CNG, but also in ships, marginally starting to use LNG instead of oil. And of course, you have electrification, and you have also plug-in hybrids. You know, as an example here, this is projected to, on average, use 0.25 liters per 10 kilometers. My Subaru 4-wheel drive, which I have in Norway, uses maybe 0.8 liters. You know, this is an incredible reduction in fuel consumption by a big family car. And then just looking a few years ahead, you have all the other car companies saying that they're going to release electric cars as well. So this is the demand side, and I think this is really shaping the picture for OPEC. Before, they could reduce production a little bit and drive up the price quite a lot, and it would take 5 years before new supply would come online outside of OPEC, because it takes a long time. Now, if they tweak the volume and drive up the price, US shale is going to deliver more volume within a year. And then the price is going to fall back again. So they cannot really drive up the price very long before it falls back. And then, of course, this is a very big question, what about demand side? You know, consumption of oil is growing maybe 1.5% a year. It doesn't take much to change that to zero growth in oil consumption by using LNG or hybrids, plug-in hybrids, or electric. And the moment you move into a situation with zero growth, it's very hard to have a high price. I think this is the other picture that OPEC is thinking of. If the price is too high, this shift is going to move very fast. And, you know, what are the big car companies saying? Nissan says that by 2020, 10% of total cars sold from Nissan is going to be fully electric. Fiat Chrysler is saying that between 20 and 2025, mostly all of their models will be hybrid models. And Toyota is saying by 2050, they will really not sell regular gasoline cars anymore. You know, what is that in the sound of, in the ears of OPEC? Doesn't really sound good. I mean, they have like hundreds of years of horizon. Like, what do you mean cars not using oil? I don't like that. You know, so I think the only strategy left for OPEC in terms of making money is volume. More volume means more revenue, because it's very difficult for them to control the price. And that is what we see that OPEC is doing now. They are increasing volume. Increasing volume and planning to increase volume more. And then we have fuels in competition. You know, and that is, I think more technology, new technology, is increasingly intensifying the competition between the fuels. And especially so for oil within the energy complex. Increasingly competing towards gas, and also increasingly competing towards coal through electricity, with electrification and plug-in hybrids. Which means that if these prices are going to stay low, it will be very difficult for the oil price to stay high, if it's increasingly in competition with the elements. And if we look on comparable cost of coal and gas, you know, they cost less than $20 per barrel in comparison. Europe maybe $35 per barrel. So that is sort of the reference price at the moment. And one of the reasons why we think that coal and gas prices are going to stay low is because consumption is not going to grow so much. If we look on power consumption globally, it typically increases by 3.5% every year. Normally, this has been provided mostly by coal and gas. But looking at towards the next 5 years, we see that total consumption growth per year is about 750 terawatt-hours of power. Scandinavia, in comparison, consumes some 400 terawatt-hours per year. And of these, a large part is going to be renewable energy, hydro, wind, solar, other forms of renewable energy. And you have going to have a solid chunk of nuclear power. And then it's about 1% growth left for coal and gas, because it's so much new renewable energy that is going to be providing a part of the consumption growth. To really have a solution, though, for the climate, you need to have this one bigger than the growth rate in power, so that actually the growth rate of fossil fuels goes down. But this is part of the picture why I think that coal and gas, in addition to being in oversupply due to overinvestments, are going to be fairly low over the years to come, which makes it also more difficult for oil price to go high due to increasing competition between fuels. And then just last picture in terms of the longer term picture. You know, through the whole period of the 2000s, we talked about this boom in consumption of commodities, this decline in ore grades and qualities and availability of commodities, and this increasing cost picture of commodities going to be forever moving higher. However, the general picture in commodities historically has been that in real term prices they are falling because technology and innovation is moving faster than depletion. You can always do it more efficiently, more cheaply with technology. It hasn't really been so for oil, which can be discussed in length why. But I think this kind of separation of oil from the rest of the commodity complex may be coming to an end because it's increasingly more a competition with coal and gas and other commodities. So it will be forced to be following the others, so maybe oil is going to be, in real terms, also moving lower. But we have these massive cuts in investments, and it may hit the market in 2018 to 2020, because electrification and hybrid cars may not have become widespread enough at that moment. So we might have one big upturn in the oil price again before we get forever lower oil prices. So that's my final word. I don't know if I overran my time. No, not too much. So we take the questions afterwards with feedback, yeah?